Silver is no longer behaving like a normal commodity, and that is the most important signal investors need to understand right now. This is not about price targets, hype, or short-term speculation. What's unfolding beneath the surface is a structural shift in how silver is sourced, stored, and demanded globally. The question is no longer whether silver prices will rise, but whether the market can even function normally as we move toward 2026. For decades, silver was treated as an abundant industrial input, something manufacturers could source cheaply and quickly whenever needed. That assumption is now breaking down. Modern industries depend on silver not because it's expensive, but because it's irreplaceable. When availability tightens, price becomes secondary. Production continuity becomes everything. This single fact explains why silver behaves differently from gold during supply shocks. Unlike oil or copper, silver operates on razor-thin inventories. Most industrial users do not stockpile months or years of supply. They rely on what's known as just-in-time delivery. That system works perfectly in stable markets. It collapses under stress. When even a small disruption occurs, buyers are forced to secure supply immediately, regardless of price, and that urgency creates explosive moves. Here's where the futures market enters the story. On paper, silver appears plentiful. Hundreds of millions of ounces trade daily through futures contracts. But paper volume is not the same as physical availability. The futures market assumes that most participants will roll contracts forward instead of taking delivery. That assumption is now being challenged in ways the market has not seen in decades. Open interest in silver futures represents claims far exceeding deliverable supply. In normal conditions, this mismatch doesn't matter, but when volatility rises and confidence weakens, even a small percentage of traders demanding delivery can drain exchange inventories rapidly. That's when exchanges respond not with reassurance, but with defensive measures like margin increases and trading restrictions. Margin hikes are not neutral actions. They force leveraged players to either inject fresh capital or liquidate positions immediately. Historically, these moves were used to crush rallies, but something different is happening now. Instead of collapsing, silver prices are absorbing these shocks. That tells us the buyer base has changed. Weak hands are gone. Strong hands are stepping in. Industrial buyers don't care about technical charts. They care about one thing: uninterrupted production. Solar manufacturers, technology firms, and electric vehicle producers cannot substitute silver without redesigning entire systems. If supply becomes uncertain, they don't wait for dips. They secure metal at almost any price. This creates demand that is completely insensitive to short-term volatility. To understand how extreme this imbalance has become, you have to compare annual mine production to global demand. The numbers no longer line up. Each year, the market consumes more silver than is mined. That deficit has been quietly filled by above-ground inventories. Those inventories are now shrinking. Once they're gone, price becomes the only rationing mechanism left. This is why silver reacts violently when stress appears. The market isn't just pricing metal, it's pricing trust. Trust that contracts can be settled. Trust that supply chains won't break. Trust that inventories actually exist where spreadsheets say they do. When that trust weakens, silver doesn't rise gradually. It gaps, spikes, and dislocates. As we move toward 2026, these pressures do not ease, they compound. Demand from energy transition technologies accelerates. Mining supply remains constrained. Exchange inventories continue to decline, and institutional buyers increasingly compete with industry for the same limited ounces. This is not a cycle, it's a structural squeeze, and we are only in the early stages. One of the most misunderstood aspects of the silver market is how quickly confidence can evaporate once physical delivery becomes a real concern. Futures markets are built on trust, not metal. As long as participants believe contracts will be settled smoothly, leverage expands safely. But once doubts emerge, even briefly, participants begin to reassess exposure. That reassessment alone can drive violent price behavior. This is why margin policy matters so much. Exchanges don't raise margins because markets are healthy. They raise margins because volatility threatens system stability. Every margin hike signals stress beneath the surface, and when repeated hikes fail to suppress price, it sends a far more powerful message. Selling pressure is no longer dominant. The market is absorbing forced liquidation without breaking. In past silver cycles, margin increases triggered collapses because speculative money dominated positioning. Today, the structure is different. Long positions are increasingly held by entities with operational needs, not speculative goals. These buyers are prepared to post additional capital, roll exposure forward, or convert paper claims into physical holdings. Their time horizon is measured in years, not trading sessions. This shift changes everything. When industrial and institutional buyers dominate demand, price becomes secondary to access. A solar manufacturer does not care whether silver is $30 or $100. What they care about is whether they can source metal consistently. Production delays cost far more than higher input prices. This dynamic places a hard floor under demand. At the same time, supply growth is remarkably inelastic. New silver mines take years to permit, finance, and develop. Many silver deposits are byproducts of other metals, meaning production cannot be ramped up independently. Even at higher prices, output does not respond quickly. This creates a widening gap between immediate demand and delayed supply response. Above-ground inventories once acted as a buffer. Today, that buffer is thinning. Large holders are increasingly reluctant to lease or sell metal into the market. Leasing rates reflect this hesitation. Rising lease rates are a warning sign that physical silver is becoming scarce at the margins. They indicate stress not visible on price charts alone. Another critical factor heading into 2026 is inventory concentration. A growing share of remaining silver is held by a relatively small group of entities. When ownership concentrates, liquidity deteriorates. Markets function best when many participants are willing sellers. When sellers disappear, prices adjust abruptly rather than smoothly. This is why silver often moves in gaps rather than trends. Price doesn't climb step by step. It jumps when sellers step away and buyers are forced to chase. These dislocations feel chaotic, but they are logical outcomes of tight physical markets. They represent moments when price finally reflects underlying scarcity. Meanwhile, public perception lags reality. Many investors still view silver through outdated lenses, expecting it to behave like it did decades ago. But the industrial role of silver has expanded dramatically. Energy transition, electrification, and digital infrastructure all depend on properties silver uniquely provides. Demand is structural, not cyclical. As 2026 approaches, these forces converge. Persistent deficits, constrained supply, rising delivery risk, and price-insensitive demand create conditions where small shocks produce outsized reactions. This is the environment in which parabolic moves are born, not from speculation alone, but from systemic imbalance finally asserting itself. Another overlooked driver heading into 2026 is how inventory behavior changes once price volatility becomes accepted rather than feared. Early in bull markets, volatility scares participants away. Later, volatility becomes confirmation. When markets stop reacting negatively to sharp swings, it signals confidence that higher prices are sustainable rather than speculative. This transition is critical because it alters hedging behavior across the supply chain. Miners hedge less aggressively when they believe prices will remain elevated. Industrial users hedge more aggressively when they fear scarcity. Both behaviors reduce available supply in spot markets, reinforcing tightness even without a change in headline demand numbers. At the same time, monetary conditions remain structurally supportive. Even without aggressive rate cuts, real yields remain constrained by debt levels. Governments cannot tolerate sustained high real rates without fiscal consequences. This environment favors tangible assets that are not easily expanded, especially those with industrial utility alongside monetary characteristics. Silver sits uniquely at that intersection. It is not purely monetary like gold, and it is not purely industrial like copper. This dual role amplifies demand during periods of both inflation concern and industrial expansion. Few assets benefit simultaneously from macro instability and technological growth. Silver does. Another factor accelerating the move toward 2026 is capital rotation. Large pools of capital do not chase returns blindly. They wait for confirmation, then move decisively. Once silver establishes credibility above prior resistance levels, allocation models begin to adjust. Even small percentage reallocations from large portfolios create disproportionate demand. This is why silver bull markets often feel sudden. The groundwork is laid quietly over years. Then, once thresholds are crossed, price discovery accelerates rapidly. What appears to be speculation is often delayed recognition. Markets do not move when information exists, they move when information is accepted. Retail participation usually arrives last. By the time silver is widely discussed in mainstream media, much of the structural move is already underway. This late-stage participation adds fuel but is rarely the initial driver. The real pressure comes earlier from institutions securing exposure before availability becomes constrained. Psychology also shifts at higher prices. As silver moves beyond levels once considered impossible, narrative resistance collapses. Skeptics turn neutral. Neutrals turn bullish. Former sellers become buyers. This cascading change in mindset reduces selling pressure precisely when demand is increasing. Importantly, this cycle is not driven by a single event. It is driven by accumulation of stress. Supply deficits, delivery concerns, industrial dependency, and monetary constraints reinforce each other. Remove any one factor, and the market still tightens. Together, they create an environment where price must adjust sharply to restore balance. Looking toward 2026, the question is no longer whether silver fundamentals are improving. The question is how long price can lag reality. History shows that when this gap becomes too wide, adjustment happens rapidly. Markets do not correct gently when inventories are thin and buyers are urgent. This is why forecasts based solely on linear models often fail. Parabolic moves are not predictions, they are outcomes of imbalance. They occur when marginal supply disappears and marginal demand becomes price insensitive. Silver is approaching that threshold where price becomes the only variable left to adjust. Risk management in this environment requires a different mindset. Volatility is not a signal to exit structurally strong positions. It is a feature of the transition phase. Those unprepared for large swings will be shaken out repeatedly, even if the broader trend remains intact. For long-term participants, the focus shifts from short-term price targets to structural signals, inventory levels, lease rates, delivery volumes, and industrial procurement behavior. These indicators reveal far more about the future trajectory of silver than daily price fluctuations ever could. As 2026 approaches, silver's role in the global system becomes clearer. It is no longer a niche commodity or a speculative trade. It is a strategic input embedded deeply within energy, technology, and infrastructure. Markets eventually price strategic importance correctly, but rarely in advance. The coming years are likely to redefine how silver is valued, traded, and understood.
What feels extreme today may look conservative in hindsight. Parabolic moves do not announce themselves politely. They emerge when constraints meet urgency. And by the time they are obvious, positioning becomes the real challenge.